Are you already thinking about your investment plans for 2024? It's a question that might seem distant, but in the realm of finance, the early bird truly does catch the worm. Planning ahead for investments isn't just a matter of foresight, it's a pathway to financial success. It's like embarking on a long journey. You wouldn't set off without a map, would you? The same goes for your financial journey. Having a clear investment plan is like having a map that guides you towards your financial goals. It helps you understand where you're headed, the paths you can take, and the obstacles you might encounter along the way. Now, there are many routes to financial success, and they all depend on your individual goals, risk tolerance, and time horizon. These routes are like different types of investments, each with its own unique features and potential returns. But today, we're going to focus on two popular paths that have proven to be promising for many investors: stocks and exchange-traded funds, or ETFs for short. Stocks represent ownership in a company. When you buy a stock, you are buying a piece of that company and its future earnings. On the other hand, ETFs are more like a basket of stocks. They allow you to invest in a wide range of companies at once, spreading your risk across different sectors and geographies. Both stocks and ETFs offer a solid avenue to grow your wealth, but they come with their own set of risks and rewards. That's why it's crucial to understand what they are, how they work, and how they can fit into your overall investment strategy. So, as we stand on the precipice of 2024, let's take a moment to prepare for the journey ahead. Let's arm ourselves with knowledge, with understanding, and with a clear vision of where we want to go. Because in the world of investing, the future belongs to those who prepare for it today. Now that we have established the importance of planning ahead, it's time to delve into the basics of stocks and ETFs. To make informed investment decisions, you first need to understand what stocks are. Let's start with the basics. Stocks, also known as shares or equities, are units of ownership in a company. When you purchase a stock, you're buying a piece of that company, becoming a shareholder. This means you own a fraction of the company's assets and earnings. Now, why do companies issue stocks? Simple. They do it to raise money. Instead of taking out loans or issuing bonds, companies sell shares of stock. This is known as equity financing. It's a win-win situation. The company gets the funding it needs to grow, and you, as an investor, get the opportunity to share in the company's future profits. But how are stocks bought and sold? This happens in marketplaces known as stock exchanges, like the New York Stock Exchange or the NASDAQ. Stocks are traded during specific hours, and their prices fluctuate throughout the trading day based on supply and demand. Here's an interesting fact. Did you know that you can make money from stocks in two main ways? First, through capital appreciation, which means selling the stock for more than you paid for it. Second, through dividends, which are a portion of the company's earnings distributed to shareholders. However, it's crucial to remember that investing in stocks is not without risks. The stock market can be volatile, with prices rising and falling rapidly. This means you could potentially lose your investment. Factors like the company's performance, economic conditions, and market sentiment can all affect a stock's price. Furthermore, while stocks have the potential for high returns, they also require research and understanding. It's essential to evaluate the company's financial health, its competitive position in the industry, and its growth prospects before investing. So, stocks can be a great investment, but like all investments, they come with their own set of risks. As the old saying goes, don't put all your eggs in one basket. Diversification is key to managing these risks and building a resilient portfolio. Now that we have a grasp on stocks, let's turn our attention to ETFs. ETFs, or exchange-traded funds, are a type of investment fund and exchange-traded product traded on stock exchanges much like individual stocks. They are designed to track the performance of a specific index, sector, commodity, or asset. In simpler terms, when you buy shares in an ETF, you're buying a slice of an entire portfolio, offering you a way to invest in a broad market sector or industry without having to buy shares in every individual company. So why might investors choose ETFs? Well, one major draw is diversification. Because an ETF represents a basket of different assets, it can help spread your risk. Instead of putting all your eggs in one basket with a single stock, ETFs allow you to invest in many baskets at once. Another key advantage is accessibility. ETFs can be bought and sold during trading hours just like stocks. This flexibility means you can respond to market changes in real time, something that's not possible with traditional mutual funds, which only trade at the end of the day. And let's not forget about cost. Generally, ETFs tend to have lower expense ratios than mutual funds, making them a more cost-effective way to invest. This is because most ETFs are passively managed, designed to mirror the performance of an index rather than beat it. But while ETFs offer these potential benefits, they're not without their risks. Just like with stocks, the value of an ETF can go down as well as up. And because they're traded like stocks, they're subject to market volatility. Plus, while diversification can help spread risk, it doesn't eliminate it. If the market sector or industry the ETF is tracking performs poorly, your investment could suffer. So, in conclusion, ETFs offer a way to diversify your portfolio, but they also come with their own set of risks. As with any investment, it's important to do your homework and understand what you're investing in before you take the plunge. Now that you understand what stocks and ETFs are, it's time to discuss investment strategies. In the world of investing, there's no one-size-fits-all approach. Your strategy should be tailor-made to fit your financial goals, risk tolerance, and investment horizon. Let's start with the question of timing. Are you a short-term investor or a long-term one? If you're looking for quick returns, you might be inclined toward short-term investing. But remember, this approach can be risky as market volatility can lead to significant losses. On the other hand, long-term investing is about patience and perseverance. It's about investing in companies or ETFs you believe have a bright future, and holding on to them for years or even decades. Historically, long-term investing has been shown to yield substantial returns. Next, let's talk about diversification. This is the practice of spreading your investments across different types of assets to reduce risk. Think of it as not putting all your eggs in one basket. If you invest all your money in a single stock or ETF and it performs poorly, you could lose a significant portion of your investment. But if you spread your investments across different stocks and ETFs, a poor performance by one can be offset by good performances by others. Lastly, it's crucial to do your own research. Don't just rely on tips and advice from others. Look at the company's financial reports. Check the performance of the ETF. Understand the market trends. The more informed you are, the better your investment decisions will be. Now, these strategies might seem simple, but they are the bedrock of successful investing. They help you navigate the choppy waters of the stock and ETF markets and steer you towards your financial goals. Remember, every investor is different, and the best strategy for you will depend on your individual goals and risk tolerance. We've covered a lot of ground today, so let's quickly recap. We started off by setting the stage for investment, understanding the crucial role it plays in shaping our financial future. We delved into the world of stocks, unraveling the intricacies of buying shares in a company and how that could potentially lead to profit or loss based on the company's performance. We then ventured into the realm of exchange-traded funds or ETFs, highlighting their unique ability to track an index, sector, commodity, or even a basket of assets. We discovered that ETFs serve as a brilliant tool for diversification, managing risk, and capitalizing on market trends, all the while offering the liquidity of a common stock. We also explored the potential benefits and risks of these investment vehicles. On one hand, stocks and ETFs can offer significant returns and help build wealth over time. On the other hand, the inherent market volatility means there's always a risk of loss, making it vital to invest wisely and prudently. Next, we discussed some common investment strategies. We talked about long-term investing, where patience and a keen eye for value can lead to substantial gains. We also touched on short-term trading, a more hands-on approach that requires constant market monitoring and swift decision-making. And let's not forget about dollar-cost averaging, a strategy that focuses on consistent investing over time, regardless of market conditions, to reduce the impact of market volatility. As we look ahead to 2024, remember that knowledge is power when it comes to investing. So keep learning, keep planning, and here's to your financial success. With the basics of investing in stocks and ETFs under our belt, let's now delve into some promising picks for 2024. Remember, while we're highlighting these options, your investment choices should always reflect your financial goals, risk tolerance, and investment horizon. First up, we have Tesla Inc., TSLA. Known for its innovative electric vehicles and clean energy solutions, Tesla has shown remarkable growth in recent years. With its constant push for technological advancements and sustainable energy, Tesla is expected to maintain its upward trend. Next on our list is the Invesco QQQ Trust, QQQ. This ETF tracks the NASDAQ 100 index, which is comprised of the 100 largest non-financial domestic and international companies listed on the NASDAQ stock market. If you're looking for exposure to the technology and innovation sectors, this ETF might be a good fit. Now let's talk about Amazon.com Inc., AMZN. As a dominant force in e-commerce and cloud computing, Amazon continues to diversify its offerings and expand into new markets. With its consistent performance and growth potential, Amazon remains an interesting pick for many investors. Lastly, we have the SPDR S&P 500 ETF Trust, SPY. This ETF mirrors the S&P 500 index, providing exposure to a broad range of large-cap U.S. companies across various sectors. It's a popular choice for investors seeking to replicate the performance of the U.S. equity market. These are just a few of the stocks and ETFs that could be interesting to watch in 2024. However, let's not forget that investing involves risks, including the potential loss of principal. Always conduct your own thorough research and consider seeking advice from a qualified professional before making any investment decisions. Up next, we wrap up our investment journey with some final thoughts and tips.